Is inflation making you nervous about your savings? Do you feel like you're losing money every day? Don't worry, you're not alone. Millions are looking for ways to protect their investments during this turbulent time. And in this video, we're going to explore two popular options, gold and Bitcoin. We'll analyze their potential as inflation hedges and help you understand the key differences between these two assets. Hit that subscribe button below to dive into the world of smart investing with me. Gold has always been seen as a safe haven during times of economic uncertainty. It's a tangible asset that holds value regardless of the state of the market. Bitcoin, on the other hand, is a digital currency that has gained massive popularity in recent years. It's considered by some to be a decentralized form of gold and is touted as a hedge against inflation. But how do these two assets stack up against each other in the current inflationary environment? The allure of AI lies in its potential to automate complex tasks, freeing up human time and resources for more creative endeavors. However, the current state of AI technology raises concerns about its impact on employment, privacy, and even the very essence of what it means to be human. While AI can undoubtedly enhance efficiency and productivity, it's crucial to consider the ethical implications of its development and deployment. A key concern is the potential for AI to displace human workers. As AI systems become more sophisticated, they can perform tasks that were once thought to be the exclusive domain of humans. This raises questions about the future of labor markets and the need to retrain and reskill workers to adapt to the changing job landscape. The automation of jobs may also lead to increased income inequality, as those with access to advanced technology and skills benefit disproportionately. Another critical ethical issue is the potential for AI to erode privacy. AI systems rely on vast amounts of personal data to function effectively. This data can be used for targeted advertising, profiling, and even surveillance. While data privacy laws exist, they are constantly evolving, and new challenges arise as AI technology progresses. The potential for AI to be used for malicious purposes, such as identity theft or manipulation, is a serious concern. Beyond employment and privacy, AI also raises fundamental questions about human intelligence and creativity. As AI systems become increasingly capable of generating art, music, and even literature, we may need to redefine our understanding of what it means to be human. The possibility of AI surpassing human intelligence, known as the singularity, is a subject of ongoing debate and speculation. The ethical implications of AI are complex and multifaceted. While AI holds immense potential for good, it's essential to proceed with caution and ensure that its development and deployment are guided by ethical principles. Open dialogue, robust regulations, and a commitment to responsible innovation are critical to mitigating the risks and maximizing the benefits of this transformative technology. Let's first define what we mean by inflation hedging. An inflation hedge is an investment that is expected to hold its value or even increase in value when prices are rising. In theory, gold and Bitcoin could both be good inflation hedges. Gold has historically been a reliable inflation hedge, but in the modern era, this is not as clear-cut. Bitcoin, with its limited supply and its independence from traditional financial systems, has also been touted as an effective inflation hedge. However, it's still a relatively new asset class, and its long-term performance in inflationary periods is yet to be fully understood. So, how do we compare these two assets in the current inflationary climate? Let's consider the factors that make gold a potential inflation hedge. First, gold has a long history as a store of value. It's been used as a form of currency and a hedge against inflation for centuries. Secondly, gold is a tangible asset, which means that it can be held physically. This makes it less vulnerable to government manipulation or technological disruptions. Third, gold is considered a safe haven asset. When markets are volatile, investors tend to flock to gold as a way to preserve their wealth. Now, let's examine the characteristics that could make Bitcoin an inflation hedge. First, Bitcoin has a finite supply. Only 21 million Bitcoins will ever be created, which makes it a potential hedge against inflation. Secondly, Bitcoin is a decentralized asset, meaning that it is not controlled by any government or financial institution. This makes it less susceptible to government intervention and manipulation. Lastly, Bitcoin has the potential for rapid price appreciation. It's not uncommon for Bitcoin's price to surge in value, especially during periods of economic uncertainty. To further understand the effectiveness of each asset as an inflation hedge, we need to look at some relevant studies and data. One study published by the World Gold Council found that gold has historically been a reliable inflation hedge. The study analyzed gold prices over the past century and found that gold has consistently outperformed other asset classes during periods of high inflation. However, the study also acknowledged that gold's performance in recent years has been less impressive, as investors have become increasingly drawn to other assets, such as Bitcoin. Another study, conducted by the University of Cambridge, examined the potential of Bitcoin as an inflation hedge. The study found that Bitcoin's price has indeed risen during periods of inflation, but that the correlation between Bitcoin prices and inflation is not always strong. The study concluded that Bitcoin's potential as an inflation hedge remains uncertain, as its volatility and limited adoption make it difficult to predict its long-term performance. In addition to academic studies, there are also a number of market indicators that can be used to assess the effectiveness of gold and Bitcoin as inflation hedges. For instance, the gold to silver ratio is often used as a gauge of investor sentiment toward gold. A high gold to silver ratio suggests that investors are seeking safe haven assets, while a low ratio indicates that investors are more optimistic about the economy and less interested in gold. Similarly, the Bitcoin Dominance Index, which measures Bitcoin's share of the total cryptocurrency market capitalization, can be used to gauge investor sentiment toward Bitcoin. A rising dominance index suggests that investors are bullish on Bitcoin, while a falling dominance index indicates that investors are more interested in other cryptocurrencies. Ultimately, the effectiveness of gold and Bitcoin as inflation hedges depends on a variety of factors, including the severity and duration of the inflationary period, the overall macroeconomic environment, and investor sentiment. While gold has a long history of serving as an inflation hedge, Bitcoin is still a relatively new asset class, and its long-term performance in inflationary periods is yet to be fully understood. Investors seeking to hedge against inflation should carefully consider the risks and rewards associated with both gold and Bitcoin before making any investment decisions. Gold has historically been a more effective inflation hedge than other assets like stocks and bonds over the long term. However, other studies have shown that gold's performance against inflation has been weaker in recent years. This decline in performance could be attributed to a variety of factors, such as the increasing supply of gold, the growing popularity of other inflation hedges, and the overall strength of the global economy. Bitcoin's performance in relation to inflation is more difficult to analyze because it's a relatively new asset class. There isn't enough historical data to draw definitive conclusions, but some studies suggest that Bitcoin has the potential to be an effective inflation hedge. One study, published by the Cambridge Center for Alternative Finance, found that Bitcoin has a strong correlation with inflation, suggesting that it could be used to protect against rising prices. This correlation could be due to the fact that Bitcoin is a decentralized digital currency, which makes it less susceptible to government manipulation and inflationary pressures. While Bitcoin's potential as an inflation hedge is promising, it's important to note that it's also a highly volatile asset. The value of Bitcoin can fluctuate significantly in a short period of time, and there is a risk that it could lose value completely. Ultimately, whether gold or Bitcoin is a better inflation hedge depends on your individual circumstances, investment goals, and risk tolerance. Gold is a more established and stable asset, while Bitcoin is a newer and more volatile asset. If you're looking for a relatively safe and predictable investment, gold may be a better option. However, if you're willing to take on more risk for the potential of higher returns, Bitcoin could be a better choice. Here are some practical tips to consider. Diversify your investments. Don't put all your eggs in one basket. Invest in a mix of assets, including gold, Bitcoin, and other traditional investments, to reduce your overall risk. It's important to diversify your portfolio across different asset classes to mitigate your overall risk. For example, you could invest in a mix of stocks, bonds, real estate, commodities, and cryptocurrencies. This will help you to protect your investments from market downturns and ensure that you have a balanced portfolio. Do your research. Before you invest in any asset, it's important to understand its risks and potential rewards. Read articles, watch videos, and talk to financial professionals to gain a comprehensive understanding of gold and Bitcoin. Before you invest in any asset, it is crucial to conduct thorough research to understand its risks and potential rewards. This includes reading articles, watching educational videos, and consulting with financial professionals to gain a comprehensive understanding of the asset. Start small. Don't invest more than you can afford to lose. As you become more comfortable with the market, you can gradually increase your investment. Starting small is essential, particularly when investing in volatile assets like Bitcoin. This helps you to limit your potential losses and gradually increase your investment as you gain experience and confidence. Consider the fees. Both gold and Bitcoin come with associated fees. Research the fees associated with each asset before you invest. It's essential to consider the associated fees when investing in gold or Bitcoin. These fees can include storage fees, transaction fees, and trading fees. Be sure to research and compare the fees associated with each asset before making an investment. Be patient. Investing in gold or Bitcoin is a long-term game. Don't expect to get rich quick. Be patient and stay disciplined with your investments. Investing in gold or Bitcoin is a long-term strategy that requires patience and discipline. It's important to avoid impulsive decisions and to stay committed to your investment plan, even during periods of market volatility. Investing in gold or Bitcoin is a complex decision. There's no one-size-fits-all answer to which is the better inflation hedge. It depends on your individual needs, risk tolerance, and investment goals. The key is to research, understand the risks involved, and make an informed decision that aligns with your financial objectives. As we navigate this uncertain economic landscape, remember, knowledge is power. Stay informed, stay engaged, and continue to expand your understanding of these powerful assets. Subscribe to our channel for more insightful videos on financial topics that matter. Let's stay ahead of the curve together.